Did you know that if you had invested just $100 in Amazon when it first went public, today that investment would be worth more than $120,000? Imagine that for a moment. You're back in 1997, and you decide to invest a mere $100 in a fledgling online bookstore. Fast forward to today, and that modest investment has grown to a staggering $120,000. And all you did was sit back and let your money work for you. That's the reality of investing, the potential for exponential growth over time. It's like planting a seed and watching it grow into a towering tree. But instead of soil, water, and sunlight, your investments need time, patience, and a dash of courage. And it's not just Amazon. There are countless other success stories out there, from Apple to Tesla, from Microsoft to Google. Companies that started as small ventures and grew into global giants, turning their early investors into millionaires, or even billionaires. That's the power of investing, and it's what we're going to talk about today. Have you ever heard of the term compound interest? It's not magic, but it might as well be. Let's break it down. Simply put, compound interest is the interest on your initial investment, plus the interest that has accumulated over time. It's interest on interest, if you will. It's like a snowball rolling down a hill, gaining more snow and getting larger as it goes. The bigger the snowball gets, the more snow it picks up and the faster it grows. That's the magic of compound interest. Now let's imagine you're an investor. You invest $1,000 with an annual interest rate of 5%. At the end of the first year, you'd have earned $50 in interest, making your total $1,050. But here's where the magic happens. In the second year, you're not just earning interest on your original $1,000. No, you're earning interest on the $1,050. So, at the end of the second year, you'd have earned $52.50 in interest, making your total $1,102.50. And this process continues year after year, with your money growing exponentially. And why is this so powerful for investors? Because it means the longer you leave your money invested, the greater your potential return. It's a long-term game. The magic isn't in the initial investment, but in the patience to let your money work for you over time. So as you can see, compound interest is a powerful tool that can help your investments grow exponentially over time. It's not magic, but with patience and a long-term perspective, it might as well be. Now, have you ever wondered how long it would take for your investment to double? Well, there's a simple way to figure that out. Enter the rule of 72. It's a financial shortcut that helps estimate the number of years it will take for your investment to double in value, given a fixed annual rate of interest. This rule is a fantastic tool for investors, and it's as easy as pie to use. Here's how it works. You simply divide the number 72 by the annual rate of return. The quotient you get is the approximate number of years it will take for your initial investment to double. Let's put the rule of 72 into action with a quick example. Suppose you have an investment that yields a 7% annual return. Divide 72 by 7, and voila, you get about 10. That means it will take approximately 10 years for your investment to double. But what if your rate of return is a bit higher, say 12%? In this case, you divide 72 by 12 and get 6. With a 12% annual return, your investment will double in roughly 6 years. The rule of 72 is a practical guide, but it's not perfect. The higher the rate of return, the less accurate the rule becomes. For instance, using the rule of 72 to estimate doubling time for a 20% annual return would yield a result of approximately 3.5 years, while the actual doubling time would be closer to 4 years. Despite its limitations, the rule of 72 remains a handy tool for investors. It's a quick and easy way to gauge how changes in the rate of return can impact your investment growth over time. The rule of 72 is a quick and easy way for you to estimate the potential growth of your investments. Next, we'll delve into the concept of risk-reward trade-off, another crucial aspect of investing. Stay tuned. Investing isn't just about the potential for big rewards, it's also about understanding and managing risk. Picture this. You're standing at the foot of two mountains. One is tall, steep, and treacherous, but the view from the top is said to be breathtaking. The other is smaller, with a gentle slope and a clear path, but the view from the top, while nice, isn't quite as spectacular. This is the risk-reward trade-off in investing. The taller mountain represents an investment with high risk, but potentially high reward. It could be a young startup, a volatile stock, or an emerging market. The potential payoff is huge, but the path to the top is fraught with uncertainty and potential setbacks. The smaller mountain, on the other hand, represents a safer, more stable investment. It could be a blue-chip stock, a government bond, or a savings account. The path to the top is clear and predictable, but the view, your return on investment, won't be quite as spectacular. Now let's take a real-world example. Let's say you're considering investing in Company A, a well-established firm with a history of steady growth. It's the smaller mountain. Then there's Company B, a young, innovative firm with a lot of potentials, but also a lot of uncertainty. That's the taller mountain. Investing in Company A might not get you the highest returns, but it's a safer bet. You're more likely to see a steady, albeit modest, growth in your investment. On the other hand, investing in Company B could yield significant returns if the company takes off. But it could also result in losses if the company fails. The key is to find a balance that suits your risk tolerance and financial goals. Are you a thrill seeker, willing to take on more risk for the chance at a higher reward? Or are you more of a cautious climber, preferring to take the safer, steadier path? Understanding the risk-reward trade-off is a crucial part of making smart investment decisions. You've probably heard the saying, don't put all your eggs in one basket. Well, that's particularly true when it comes to investing. Diversification is essentially the practice of spreading your investments around. It's like a buffet. You don't just load up on the mashed potatoes and ignore the roast beef and vegetables. You take a little bit of everything to get a balanced meal. In the same way with investing, you don't want to put all your money into one stock or bond or even one sector of the market. Why is this important? Well, let's imagine you put all your investment into one company's stock. What happens if that company goes under? You lose everything. But if you had invested in multiple companies, even if one does poorly, the others might do well and offset the loss. So how can you achieve diversification? It's not as hard as you might think. You can diversify by investing in a variety of asset classes like stocks, bonds, and real estate. You can also diversify within those asset classes. For example, within stocks, you can invest in different sectors, such as technology, healthcare, and consumer goods. And within those sectors, you can invest in companies of different sizes, from large multinational corporations to small startups. Here's an example to illustrate the point. Let's say you invested in a tech company that unfortunately went bankrupt. If all your money was in that one company, you'd be out of luck. But if you also had investments in a thriving healthcare company and a stable consumer goods company, those investments could help balance out the loss from the tech company. So the key takeaway here is this. Don't put all your eggs in one basket. Spread your investments around. It's one of the most effective strategies for managing risk in your investment portfolio. And remember, while diversification can't guarantee profits or protect against all losses, it can help you manage risk and potentially increase your overall returns. Diversification can help you manage risk and potentially increase your overall returns. So there you have it. Investing might seem complex, but once you understand the basics, it's not so scary after all. Let's quickly recap what we've learned today. We've unearthed a surprising fact about investing, that it's not just for the elite, but for everyone. We've marveled at the magic of compound interest, the eighth wonder of the world, that can turn a small sum into a fortune over time. We've grasped the rule of 72, a simple formula that gives you an estimate of how long it will take to double your investment. We've acknowledged the risk-reward trade-off, understanding that higher potential returns often come with higher risk. And lastly, we've underlined the importance of diversification in reducing risk and smoothing out our investment returns over time. If you enjoyed this video and found it informative, don't forget to subscribe to our channel for more insightful content on investing. Remember, the power to grow your wealth is in your hands.